All right, folks, settle in, grab your lukewarm coffee, and welcome back to Daily Market Narrative, where we try to make sense of the financial chaos so you don't have to. Today, we're navigating a market that's apparently doing a bit of a tightrope walk, balancing on one foot with a smile and the other foot hovering over a pit of, well, let's just say, uncertainty. The big story, the one plastered across every financial news ticker, is this manic swing between pure, unadulterated euphoria after Powell's seemingly dovish whispers at Jackson Hole, which has everyone convinced a September rate cut is practically a done deal. It's like they heard, "We're thinking about it," and translated it to, "Party hats on, champagne ready." But then, just when you're about to book your private jet to the moon, the market remembers that pesky little thing called reality. Suddenly, the fear creeps in, the what-ifs start to pile up. What if that upcoming inflation report is hotter than a Texas summer? What if the jobs numbers are so robust they make the Fed sweat and decide to hit the pause button again? So, we've got this bipolar market swinging from Fed pivot imminent to, maybe not so fast. It's enough to make your head spin, or at least make you question your life choices if you're trying to time this thing. Now, let's talk charts, because apparently those squiggly lines dictate the fate of trillions of dollars, which is just hilarious when you think about it. We're looking at the SPY, the ETF that's basically the heartbeat of the S&P 500. And guess what? Even on the daily chart, it's looking pretty darn bullish, almost screaming risk on. It's like it's got its party shoes on, just waiting for a few more closes above, let's call it the 645-ish level. If it can manage that, the next target, according to the chart wizards, is a cool 665. But here's the catch, the fine print in crayon, all this optimism is riding on the supports holding firm. We're talking about the 640 and, for the really brave souls, the 620 levels. So, as long as those don't crumble like a stale cookie, the chart is saying full steam ahead. Just don't ask me what happens if a rogue pigeon lands on the server farm. All right, let's pivot to the actual news that's making waves, or at least ripples in this ocean of financial commentary. First up, we have U.S. Treasury yields tick higher as investors look toward key inflation data later in the week. So, yields are nudging up like a shy person at a party because everyone's waiting for that big inflation report. It's this classic game of will they, won't they with the Fed, and any hint of inflation could send yields and market sentiment on another wild ride. The market's basically holding its breath. And higher yields? Well, that means borrowing gets a bit pricier for everyone, which can put a damper on spending and investment. Plus, a stronger dollar, which usually comes with higher yields, can make our exports look less attractive, like that slightly bruised apple at the farmer's market. Next, we've got, from the big stay to a no hire, no fire freeze, labor markets are seeing sizable shifts. Remember when everyone was quitting their jobs like it was a national sport? That's the big stay era. Now, it seems like companies are going into hibernation, a no hire, no fire freeze. They're not bringing new people in, but they're also not letting anyone go. It's like a standstill in the employment world, probably because everyone's trying to figure out what the heck is going on. The upside? Slower wage growth, fewer job openings, and for companies, it might mean stability, but also a missed opportunity to snag some fresh talent. So, less churn, but also less growth. A bit like watching paint dry, but with more economic implications. And finally, from the you can't make this stuff up, solar executives warn that Trump attack on renewables will lead to power crunch that spikes electricity prices. So, the solar industry is basically saying, hey, if you mess with our green energy, you're going to cause a power shortage and your electricity bill is going to skyrocket. It's a stark warning that dialing back on renewables could have some serious consequences for energy availability and affordability. This could mean higher inflation, a reliance on the old-school fossil fuels, and a rough time for companies that have gone all in on the green revolution. Definitely one to keep an eye on if your utility bill already gives you anxiety. Now, looking ahead, what's on the economic calendar that might shake things up? We've got a smattering of housing data coming out, like building permits, that's like a preview of future construction, and new home sales, which tells us how many houses people are actually buying. Then there's the Chicago Fed National Activity Index, which is basically a broad look at economic health, and the Dallas Fed Manufacturing Index, a more specific peek into how factories are doing in that region. We also have some Treasury bill auctions, which are just the government borrowing money, but sometimes the demand at these auctions can give us clues about market sentiment and interest rate expectations. So it's a mixed bag, but housing and manufacturing whispers can often give us a hint about the broader economic winds. And that, my friends, is our market narrative for today. We've got the Fed playing hot potato with interest rates, the charts doing their best impression of a roller coaster, and a headline buffet that's equal parts economic insight and politics football. As always, stay informed, stay skeptical, and don't forget to hydrate. We'll be back tomorrow with more of the same or something completely different. Until then, this is Dave, signing off from Daily Market Narrative.